Good morning, everybody. Dan Kautz.
Good morning, Jeff Buckley.
And here we are for September 2025 as time moves on.
That's right.
So, as you said last time we got together, August was, because everyone's away, that could be a really turbulent month because there's not a lot of action.
Right.
And what did we see?
A lot of turbulence.
Yes. So,
yeah.
But the other thing, too, is we're coming to an end of a quarter at the end of this month.
Right.
And we are getting a little more data on how markets are doing and also on how the economy may be doing. Mm-hmm. And I was looking at the slides before we prepped here. It looks like we're going to be able to talk about some labor production and things like that and see if we got some direction here, huh?
Yeah. Fed Reserve meeting coming up too. And,
yep, that's pretty big news, and it looks like data that came out earlier this week is going to support a quarter cut, right. Or a cut, at least a quarter.
Right.
And remember, when we say the Fed cuts, one cut is 0.25. So if they come out and say, oh, they did two cuts, that is a 0.5 cut.
Yeah.
So we'll see where this goes, but it's pretty exciting here.
It is.
So God forbid people can't hear me. Let me move my mic up a little bit, all right? Okay, let's get going here. Jeff, this is my slide as always. Today, this is a quick check-in call. We cannot take any texts or calls during this as we're recording. Our contact information is dkautz@kautzbuckley.com and jbuckley@kautzbuckley.com. Our phone number is 716-276-8480. And the ever-popular text number is 716-272-1129. And just a little note, we added another body to the office.
That's right.
We're very excited. Matthew Andrzejewski joined us this week, brand new to the office. So when you call in, you might hear a new voice. We're very excited to have him. He's been 3 years in the business, very strong in operations, and he's here to help out Kristen.
Yes.
So we've been really very happy about this.
Yes.
So let's move on. I think Kristen's the most happiest.
That's right.
Here we go into the charts.
Okay. Well, yeah, and again, just beginning where we always do, this is our kind of look in the rear view mirror, what happened in August. As Dan mentioned, a lot of volatility, but a couple of headlines there too. S&P 500 and NASDAQ, again, two stock indices, but they extend their multi-month winning streaks and they set fresh record highs. So at the end of the day, volatility, but yet August was a good month for us. It's noted there, Federal Reserve is likely to cut the Fed funds rate by 25 basis points in September. We've had more data since then, since that headline was written. So at least a 25% basis point is what the market is really kind of pricing in now, possibly even more. So we'll see about that. One of the keys, though, I think it's important, 81% of the S&P 500 companies beat their earnings per share and revenue estimates. So
that's huge.
That was not really expected going into this earnings season. Every quarter, every 3 months, companies have to report their earnings. And as we enter earnings season, there's always some anticipation as to exactly, how well companies will report the earnings for that prior quarter. What we were getting in through August was the earnings really for those companies for the second quarter of this year through the end of June. But the results were very positive, more positive than I think a lot of people thought going in. So that kind of helped bolster the overall performance of the stock market during the month of August.
And what else I noticed here? Look what's up near the top. Russell Midcaps, what did we talk about just a couple months ago?
That's micro. Yeah,
sorry.
So it's,
what did we talk about just a few weeks ago, or a few times ago, that the mids and the Russells are going to be room to run?
There's been a lot of talk. Yeah, and again, the Russell 2000, it's 2,000 companies, but it focuses on some of the smaller companies in our economy. So it's a good barometer really for kind of how the overall stock market is doing. And you can see it was number 2 in performance charts there. It's up 7.1% in August. And it's really been again, we've talked about this before, kind of the breadth of the market. We're getting away from everybody piling into those Magnificent Seven stocks, and we're starting to find bargains in stocks outside of the Magnificent Seven, and it's trickling all the way down to some of the smaller companies. And in addition to, with anticipated rate cuts coming from the Fed, we talked about this last month, those rate cuts definitely benefit smaller companies that rely much more heavily on borrowing to keep their operations going. They don't have this as significant of a cash flow as some of the behemoth companies out there that are more in the S&P 500. So good chart,
good
really.
chart, and it
Yes.
seems like the
Good
market's
month.
moving along okay. It just, August was a little turbulent.
Yes, it was turbulent, definitely. And this, again, just to kind of focus on the sectors. So we kind of talked about the overall indices, and we're seeing some growth in the smaller companies out there. These are the different sectors. And, as we've been talking a lot lately about technology. Well, last month, technology was closer to the bottom of the chart here when we break down our different sectors. Energy is still up there. Healthcare, which is something really had been kind of a laggard for most of this year. People are starting to look at that and say, boy, that sector has a lot of very good companies. There's some companies in there that are experiencing some difficulties too, certainly. But there's some potential very big winners in there also. Yep. So
what about precious metals? When was the last time we ever saw that so high up on the chart?
I know, it's that's right. I mean, the industrial supply and a lot of companies that are benefiting from our attempts, I think, as the country to try to reshore some of that development, and everything too. So interesting chart. And this, now again, we've looked in the rear view mirror a little bit what happened in August. This is now just kind of the current view here. And again, as we've mentioned before, Dan and I like this chart because the previous charts were focused really on the stock market. None of our clients are 100% in stocks of any size, large or even small or in between. So this is focused more on how a portfolio, something that you may look much more similar to how you're invested. These are just, they're benchmarks, but start out with, the 80% equities, 20% fixed income at the top, and then kind of run the gamut all the way down to most conservative would be the bottom there, about 20% equities and 80% fixed income. And not quite the disparity that we had seen earlier in the year. At least for our return year to date, which is now coming through, this is, I think, as of September 8th. Yeah, so this is basically through 8 full months and a touch into September as well. And we had really seen much more disparity there where some of the stocks kind of ran away with it. Some bonds had experienced some difficulty because of, again, where the environment we're in, where we know eventually these rate cuts are coming from the Fed.
Now, to that point, though, with a rate cut, where do you think this is going to go? With a rate cut, what happened? The bonds will gain. Remember the seesaw.
Right.
Rates go down, the value of a bond goes up, but the yield still remains the same. So we'll see the portfolios with bonds actually kick up a little bit with a rate cut. What do you think about equities with a rate cut? Don't you think those will benefit too?
I think so. Yeah, my expectation is that we'll start to see really a pretty positive results in both sides of the market, really.
So we could go. I'm sorry, I kind of got you off track.
Well, no. I mean, if we look kind of out, the disparity is still there when we go back a full 12 months. So back to September 8th of last year, moving forward, we can see where that disparity was, and it's just really tightened up in the 9 months of this year. So far. But yeah, again, overall good performance. We pointed out last month, we still have this persistent negative.
Just sitting there.
Yes, and it's still over 5 years. When we annualize that, it's we've still got a negative, but we're working to get those negatives all off the chart.
Yeah, but overall, feeling pretty good about the market.
Yes, definitely.
I agree.
Yeah.
So let's take a look at the outlook.
Yes, kind of out the windshield now. What are we expecting down the road?
I see green.
Yes.
Whoa.
We added a green on fiscal policy. And again, just to remind everybody, this is a chart. We just like this. It's a great visual, we think. And it's put out by City National Rockdale. They do this every month. And again, this is kind of focusing on the forward 6 to 9 months. What are they expecting? We saw a move up in monetary policy. You're kind of in the green area on fiscal policy and even credit demand and availability. So we're getting some green on the screen and some yellows
look at yield
there.
curve. The yield curve has a nice move, positive. It's still yellow, but that's really good. We talk about the market, and the market's one thing. We talk about that at the parties, right? Hey, how's the market? Hey, what are you investing in? Hey, how's that going, right? It's the economy how healthy is the economy, and that's when you get into the yield curve. That's the difference, yield rates that different types of bonds will pay. I'm not going to get into that in this short conversation, but that's a good sign.
It is,
That's
definitely.
that's a good sign.
Yes.
I personally was a little worried about that.
Yeah.
And now with the rate cut coming in, we hope, I think our economy is feeling a little better.
We're good, and just with some of the data that's kind of come in just recently, as we're recording this, just a few days
Inflation
before.
data.
Yeah, it's seeming that inflation is staying definitely under control. The labor market definitely seems to be weakening a little bit, but we'll get into that in a minute. There may be some unusual factors affecting that.
Very interesting. We're doing some research ourselves looking into that. So
yes.
how you doing on this one? You
Yeah,
good?
no, we're okay. We can jump to the next one.
You're giving me
there,
permission to move
Yes,
on?
you can go ahead and move on. Thanks.
All right, there you go.
Yeah, but this just kind of trying to continue that conversation. What are we, now that we're looking out the windshield, what are we seeing for the next 6 to 9 to 12 months? And I've had a couple clients, I thought this was interesting, and this is a very good point. It brought this up to me lately. They said, why would I put any additional money to work right now? Because we're really kind of at all-time highs in the markets. I don't want to get in at the top because the chances might be that we might fall back a little bit, and I'll wait for a better opportunity. So I found this chart. This is actually put out by AssetMark in one of their monthly letters. As you all know, we use AssetMark quite a bit. So what's the cumulative return going all the way back to 1980 when we look at investing in any day versus investing at a new high? And it's pretty interesting results. I mean, even investing at a new high, you've got a good chance of being ahead 3 years down the road, and even a better chance 5 years down the road. So the fact, looking back at the S&P from the 1920s all the way to today, we extend that even further. Investing on a day when the market is at an all-time high led to an average long-term return that is similar to investing on any random day. So it is something to keep in mind and to look at as you're putting money to work. Where are the markets? But it's not the end of the world. And again, we always go back to that.
That's what I was going to say. What do you always say, man?
The time in the markets, not the timing of the markets.
Right.
Yes.
So great chart, and I think it's a good. We've been getting those questions.
Yes, we have.
And really, I think the next chart is really showing why this may be actually the beginning.
Yes.
Of something good.
Well, this was something I came across, and again, many of our clients are invested with American funds. Dan and I've used them for years. I do think that they do a very good job of producing some of this information. So I always look at them every month when we're getting these ready. And this one kind of stuck out to me this month. So they came up with 4 charts to show that maybe why things are looking very positive for the overall market. So they kind of started out the dot-com boom and the bust. That was all about hardware, connectivity, networks, and information. All right, so
that's
they're
getting the product to the person.
Right, exactly. Now
how does a person get onto the internet?
Yes,
that
exactly.
was a big deal then. But
right, a lot of infrastructure and stuff like that. And then I'm sure many of you recall, a company would come out and they'd put .com after their names, and their stock price would skyrocket. Really no connection at all to the internet necessarily, but that's the way it was. Now, whereas the AI boom is about extracting that accumulated knowledge. And today's companies are flush with cash and have robust earnings. So 2 very key points. This is different this time than the tech boom or the .com boom, because we're now extracting that information. The information is available out there. We're figuring out the best ways to extract it and use it. And also, the companies that are growing the most from this AI boom, they're flush with cash right now. This is your NVIDIA, the chip maker. It's your Google, Meta, Alphabet. These
companies we don't even know about yet.
Well, there's many out there too.
There's some opportunity out here.
Yes, definitely. Some that are not even publicly traded yet. They're in the private markets.
Right.
So that's it. So this kind of shows, the chart. This was their first chart that American funds put out. We had the spike, the .com bubble, we had the crash, but then this is kind of where we are right now. The tech spend is now above the 90s share of gross domestic product. So we're spending a lot on tech. There will be, we need to show that this is leading to something, but it is different this time than the .com boom.
It's almost, we were planting the seed, now the harvest.
Yes. Yeah,
and this harvest could be
Could be good. So
Could be and exciting.
yeah. Well,
And
another
this is
thing
some of the
too.
excitement too, right?
It
here,
is. I
you
mean,
know?
this is very exciting, I think, because we've Dan and I, we've listened to many different money managers. We read what we can, and there's been a lot of comparisons back to, if you all remember, like Microsoft and the advent of the personal computer, the desktop computer.
What? People are going to have a computer in their house?
Well, that's it. I
What?
mean, there were days where which I certainly remember, where nobody had computers. There were no offices or anything. They started coming out. The thought was, oh my gosh, we're all going to lose our jobs. This is going to be horrible. And instead, we all became much, much more productive. And it led to increased employment. Yes, increased employment, jobs. And it also led to significantly increasing corporate earnings as well, and through productivity. So I thought this was interesting what they stated. Productivity, surges are rare. They are rare. And I mean, during our lifetimes, 2 or 3, 4 potentially, but this is one of them. This seems to be the spike here. And this is an interesting comparison. This is to certainly some well-established countries out there, Germany, Japan, UK, and here we are, we're widening our lead, in labor productivity. So a very positive thing.
There's no doubt that my wife and I, we even have the talk about what's AI doing, how's this, it's oh my gosh, it's scary and everything. Yeah. And it does harken back to the years of putting, Microsoft and Apple and the mouse. What the hell's a mouse?
Right.
And it's sad because we might be seeing layoffs first and then the opening in the next stride. And
well, that's it. Jump to the next slide.
It's going to be tough.
Well, this is right. This is a good point. I mean, the way American funds kind of projected this through this chart is they're saying labor markets are rewiring for the future. And I think that's an accurate statement. We've seen the labor market pull back. It's difficult. I personally have a daughter that's a year or 2 years out of college and looking for other potential job opportunities. There's not much out there. And that's a concern. However, U.S. jobs are shifting amid AI and tariffs. So a lot of this is being, as they put it, rewired. We're rewiring for the future. Does it mean that none of them are ever going to be able to find jobs? I don't think so. I just think that we need some more direction on where all this is headed, and that's where we're going to see those jobs start.
And you and I were also talking earlier this week when we were looking at the data, and we realized who's getting laid off. It wasn't the hourly wage. It was more of the supervisory wage, where it's a person that might be overseeing 4 or 7 people. Right. And what does that? It leads to this is the first feel of AI coming into the workforce, where you don't need that layer of supervision. A little assumption on our part, but it seems to be a little different. It's not the hourly laborer that's getting laid off.
Yeah, that's
so
true.
this is all. It's exciting.
It is. It's an interesting time now. A lot of optimism for the future. And if you jump to the next one here, this is also something, just kind of the 35,000-foot view here. Signs point to a slowdown. We certainly acknowledge that the labor market is definitely slowing down, although inflation does appear to be staying well under control.
This month, and it should be. I don't see anything.
Tariffs are still out there. There's still a lot of concern as to who's paying for the tariff impacts right now. It doesn't necessarily seem to be the consumer, which means it's probably then either the suppliers or the producers. And who's eating those costs? How is that going to affect their bottom line? What's the profitability going to be for those companies in those positions?
What's the earning in the fourth and first quarter of next year?
Right. So we've still got concerns, certainly, but this was kind of a reference to the chart that we've used this chart before, more just in general to show kind of the stages of the economy, a mid-cycle. Yeah, early, mid, late, and then recession. But what they're showing here, and again, this is not mutually exclusive. It doesn't always have to go one direction. So really their thoughts are, American funds looked at that and said they thought we were kind of close to being later in the labor market cycle there, the overall economic cycle in 24, but we've kind of moved back now. In the mid-cycle, profit margins are peaking, employment may begin starting to improve, once we get that rewiring done, and then credit demand picks up too. If rates start coming down, there's a lot of pent up, I think, home equity.
Home buying.
Yes, home buying, exactly.
Credit to small cap companies, credit to
Yes.
companies, everything you've talked about.
Yeah.
There's huge, this could be a big push.
Right, I think so. So I mean, the overall, what we're hearing right now from the money managers we work with, and kind of, I think our thoughts on this too are, September is traditionally the worst month for at least for the stock market, and we could see some continued volatility. But the middle of this month, we're going to get the Fed's decision. If they begin a new cutting cycle, they've kind of been in pause for a little bit. That should probably continue through the end of the year, potentially into next year, and there just seems to be a lot of optimism for where our economy is, how we're situated, and how we're going to be able to move into next year.
Right.
So
I got to tell you, in the last few slides and last few of these that we've done, you might have felt a little negative, a little Danny Downer coming out there, and I have been down. I've been down. The market's been okay. It's the economy I've been concerned about, and those are two very different things. The market looks good, and I agree everything we talked about. I fully think we're really on a good push forward. Yeah. The economy I was worried about, but we're beginning to see some signs that actually it looks like it's coming around,
right.
And that makes me feel a lot better. I do have concerns though coming into the first and second quarter of next year, as you said. Right now, it looks like tariffs are being eaten by suppliers or by the actual company.
Right.
When will that come through to the consumer? Who knows? And we will see.
Right.
Stay tuned, right?
That's right.
You
have our word. We'll stay on top of it. We
watching
continue to listen everything we can, and we'll keep reporting on what we hear.
Yep,
so.
We're feeling pretty good right now. So I want to thank everybody for joining us, and stay tuned. We'll be back next month, October. You're wearing a Halloween costume for that one, I heard.
We'll talk about that. We'll see.
All right, listen.
Thank
Goodbye.
you.
Go Bills.
Thanks.